Something huge is happening across Europe right now. A quiet but absolutely massive industrial revolution is underway. We're talking trillions being spent to upgrade everything from energy grids to AI. But here's the catch. The usual money players, governments, big banks, they can't foot the whole bill. So where is all this capital coming from? Well, we're about to pull back the curtain on the surprising financial engine that's making it all happen. In this quote from Apollo's president, James Zelter, it just nails it. He's not talking about small tweaks. He's calling it a global industrial renaissance. The key phrase there is massive CapEx. That's capital expenditure. You know, the money companies spend on enormous long-term projects like building new factories or data centers. This isn't about some risky startup. We're talking about the bedrock of Europe's economy completely retooling itself. And if you want a sense of the scale here, just look at Germany. To modernize its entire economy and get back on track, the country needs about $1.5 trillion. That's trillion with a T. And remember, Germany is just one piece of this continental puzzle. It gives you an idea of the colossal amount of money we're talking about. So here's how we're going to break this all down. First, we'll tackle Europe's big trillion-dollar question. Then we'll see how private capital is stepping in with the answer. We'll get specific with Apollo's European playbook, and then uncover the secret sauce that makes their whole model work. And finally, of course, we're going to follow the money.
Okay, so let's dive right into that central problem. With this incredible need for trillions in investment for things like the energy transition, AI, and defense, where on earth is that capital going to come from?
The problem is, the usual suspects are kinda tapped out. European governments, they're already dealing with a lot of debt. And the banks, well, after years of new rules and changing priorities, they just aren't lending for these kinds of huge long-term projects the way they used to. This creates a massive funding gap.
And this is why that gap is such a big deal in Europe. You see, the European economy has always been way more reliant on banks, about 70% of all lending, versus only 40% in the US. So when European banks pull back even a little bit, it leaves a much, much bigger hole to fill. And, a hole like that, that's a huge opportunity.
So when the old guard steps back, who steps in? Well, finance, like nature, abhors a vacuum. And that brings us to the answer: private capital. A whole new class of lender, think big asset managers and alternative investors, is jumping in to become the new financial backbone for Europe's industrial core.
The specific tool they're using is called investment-grade private credit. Now, I know that sounds a little jargony, but don't worry. All it really means is that firms like Apollo are making big, long-term, and super flexible loans directly to solid blue-chip companies. It's a kind of deal a bank might find too complex or just too long for their books these days. And as James Vilter points out, this isn't about replacing the public markets. Not at all. If a company can get a great deal on the bond market, they absolutely should. But for certain complex projects, the public markets just aren't the right fit. Private credit is another vital tool in the corporate finance toolbox. Okay, so we get the concept, private credit. But what does that actually look like in practice? Let's move from theory to the real world and crack open Apollo's European playbook to see how this strategy is actually playing out. So, where is this river of capital flowing? It's going straight into the foundational pillars of the new economy. I mean, think about the colossal energy and money needed for building out AI data centers, for rewiring entire power grids, for ramping up defense spending, and for funding the green energy transition. These aren't just quarterly projects. These are transformations that will take decades.
And here's where it gets really interesting. Look at these two examples. Take RWE, the big German utility. They needed cash for a huge project but didn't want to sell off part of their stake. So Apollo came in with a custom solution that let them get the funding and keep their full 25% share. Or look at Vonovia, a real estate company getting squeezed by rising rates. Apollo built them a flexible loan tied to specific assets, giving them breathing room that their public debt just couldn't offer.
All of this begs the question, how can Apollo offer these huge, long-term, super flexible loans when nobody else can? The answer is in their unique business model, something they call the origination flywheel. This is the engine that powers the whole machine.
And it's actually a beautifully simple self-reinforcing loop. Step 1. Gather liabilities. Through their retirement services business, Athene, they collect these enormous pools of stable, long-term capital from things like annuities. Think of it as patient money. Step 2. Originate assets. Their asset management side takes that patient capital and uses it to create assets, like those long-term loans to companies. And finally, Step 3. Generate spread. They make their money on the spread, the difference between what they earn on those loans and what they owe on their long-term liabilities. The flywheel just keeps on spinning.
And here's the crucial point. The nature of their capital is their single biggest advantage. While a bank or a mutual fund has to think in terms of 3 to 5 year loans or worry about people wanting their money back tomorrow, Apollo can offer capital that matches the timeline of a new power plant. We're talking 10, 15, even 20 years out. They aren't constrained by liquidity, so they can offer duration. It's a game changer.
So this all sounds great in theory, but does the model actually work? Let's do what we always do. Let's follow the money and look at the hard numbers to see how this strategy is really performing.
I mean, just look at this growth. It's staggering. Their total assets under management shot up 24% in a single year, jumping from $733 billion to over $900 billion. That shows you the incredible amount of capital that's flowing into their system.
And they are putting that money to work at an unbelievable pace. In just one quarter, they originated $75 billion in new loans and investments. To put that in perspective, that's more than the entire annual economic output of some countries, all deployed in just 3 months. That's the flywheel spinning at full speed.
This chart brings us right back to that flywheel concept. It breaks down their $520 billion in what's called perpetual capital. That's the really patient, long-term money. And look at the biggest slice of the pie, making up almost 3/4 of the total. It's Athene. This is the visual proof of that insurance engine powering their whole lending strategy.
And it all adds up to this final headline number. As of their latest report, $908 billion in assets under management. A true financial titan that's uniquely positioned to fund this new industrial age. So all of this leaves us with a final, really crucial question. We've seen the massive need, and we've seen this new model that's stepping up to meet it. As the traditional pillars of finance, governments and banks keep redefining their roles, are we quietly witnessing the rise of private capital as the new, indispensable engine for global industrial growth? The answer to that is going to shape our economy for the next decade.